Quantitative finance, or quant finance, combines mathematics with financial markets. It is a field where the precision of mathematics meets the complexity of financial systems, creating a unique blend of analytical rigor and market intuition. It uses mathematical models and vast datasets to analyze financial securities and markets. These models help in predicting market trends, pricing derivatives, and managing financial risks. The data-driven approach ensures that decisions are backed by empirical evidence. This approach helps quants make informed decisions on investment strategies and risk management. By using statistical methods and computational techniques, they can optimize portfolios and hedge against potential losses, ensuring a balanced and strategic approach to investments. Quant finance is now a cornerstone of modern finance, shaping how institutions operate. Major financial institutions rely on quantitative methods to stay competitive, innovate, and comply with regulatory standards. By leveraging models, quants identify patterns and assess risks, minimizing emotional biases. This scientific approach allows for more objective decision-making, reducing the influence of market sentiment and human error. From high-frequency trading to sophisticated risk management, quant finance transforms the financial landscape. High-frequency trading, for instance, uses algorithms to execute trades in milliseconds, capitalizing on minute market inefficiencies. We'll explore the principles, techniques, and career paths that make this field intellectually stimulating and financially rewarding. Whether you're a student, a professional, or simply curious, understanding quant finance opens up a world of opportunities and insights into the financial markets. Finance has evolved from intuition to a systematic, data-driven approach, leading to quantitative finance. Historically, decisions were based on subjective judgments and market sentiment. The advent of computing and vast financial data enabled a more analytical approach. Groundbreaking theories like KPM and the Black-Scholes model introduced mathematical rigor. Today, quant finance relies on sophisticated models, statistical analysis, and algorithmic trading. This data-driven approach has revolutionized financial markets, leading to greater efficiency and transparency. Quantitative finance is crucial in risk management and portfolio optimization. It involves the use of mathematical models and computational techniques to analyze financial markets and securities. By leveraging these advanced methods, financial analysts can make more informed decisions and predict market trends with greater accuracy. Financial institutions use quant finance to navigate market complexities and align with financial goals. This includes managing large volumes of data, identifying patterns, and developing strategies that can adapt to changing market conditions. The goal is to enhance profitability while ensuring compliance with regulatory requirements. Quants develop models to assess and mitigate risks like market, credit, and operational risks. These models are essential for understanding the potential impact of various risk factors on investment portfolios. By simulating different scenarios, quants can identify vulnerabilities and implement measures to protect assets. Techniques like value at risk, VAR, and stress testing quantify potential losses under different scenarios. VAR provides a statistical measure of the maximum expected loss over a given time frame, while stress testing evaluates how portfolios perform under extreme market conditions. These tools are vital for maintaining financial stability. Portfolio optimization focuses on constructing portfolios that maximize returns while minimizing risk. This involves selecting a mix of assets that align with the investor's risk tolerance and financial objectives. By diversifying investments, portfolio managers can reduce exposure to any single asset or market. Quants create algorithms considering risk tolerance, investment horizon, and asset correlations. These algorithms are designed to automate trading decisions and optimize portfolio performance. By continuously analyzing market data, they can adjust strategies in real time to capitalize on opportunities and mitigate risks. These techniques help investors achieve financial goals by maximizing returns within desired risk parameters. By leveraging quantitative finance, investors can make more informed decisions, enhance portfolio performance, and ultimately achieve greater financial security and growth. Unraveling the toolkit of quantitative finance techniques for success. In the fast-paced world of finance, mastering quantitative techniques is crucial for staying ahead. Quant finance uses diverse mathematical and statistical tools to extract insights from financial data. These tools help analysts make informed decisions, predict market trends, and manage risks effectively. Techniques range from statistical arbitrage to time series analysis. Statistical arbitrage involves identifying and exploiting price inefficiencies between related securities, while time series analysis helps in forecasting future price movements based on historical data. Statistical arbitrage exploits temporary price discrepancies between related securities. By monitoring these discrepancies, traders can execute profitable trades before the prices converge again. Mean reversion bets on asset prices returning to their historical averages. This technique assumes that prices will revert to their mean over time, providing opportunities for strategic investments. These strategies rely on statistical models to identify opportunities and execute trades quickly. Advanced algorithms and real-time data analysis are essential for capitalizing on fleeting market opportunities. Mastering these techniques is essential for aspiring quants to succeed in this data-driven field. Continuous learning and staying updated with the latest advancements in quantitative finance can significantly enhance one's career prospects. Navigating the career landscape of quantitative finance. Quant finance offers diverse career paths for those with varying interests and skills. Quants develop financial models and algorithms, analyzing data to identify trading opportunities and manage risk. They work closely with traders, portfolio managers, and risk managers. Quantitative developers, quant devs, translate models into efficient software applications. Quant devs possess strong programming skills and a deep understanding of financial markets. They ensure models are implemented accurately for real-time trading environments. Essential skills for aspiring quants. A blend of math, finance, and technology. Aspiring quants need technical, analytical, and financial skills. A strong foundation in mathematics is crucial for developing financial models. Proficiency in statistical modeling techniques is essential for analyzing data and making predictions. Understanding financial markets and instruments is equally important. Programming skills in languages like Python, C++, and R are indispensable. Familiarity with databases, data visualization tools, and cloud computing is increasingly important. The future of finance. Embracing the power of quantitative analysis. Quantitative finance is a fundamental shift in navigating financial markets. Alternative data sources and machine learning present new opportunities for innovative strategies. The demand for skilled quants will continue to rise as the industry relies more on quantitative analysis. The future of finance belongs to those who harness quantitative analysis to unlock new possibilities.